They just shut the door on the Arctic, and silver felt it instantly. A $137 premium exploded overnight, supply vanished, and almost nobody is explaining why. This is not a rumor. This is not a glitch. This is the moment the silver market quietly broke. It happened far away from Wall Street, far away from COMEX trading floors, in a place most investors never think about: Greenland. Frozen, remote, seemingly irrelevant, until suddenly it wasn't. When the announcement dropped, the silver market didn't scream. It snapped. Prices didn't just move, they disconnected. Physical silver ripped away from paper silver, and that gap widened faster than most people could process. That $137 premium didn't appear out of thin air. It was a signal, a warning. And for those paying attention, a confirmation that something fundamental just changed. Here's why this matters. Silver is not just an investment metal, it's a strategic material. It lives inside solar panels, defense systems, medical equipment, data centers, and the electrification plans governments keep promising. But silver has a problem that almost nobody talks about honestly. There isn't enough of it, not above ground, not easily accessible, and definitely not quickly replaceable. For years, the market relied on a fragile balance. Paper contracts smooth over physical shortages. Futures markets pretended supply could always appear if the price was right. That illusion only works until a real-world bottleneck shows up. Greenland just became that bottleneck. The Arctic lockdown wasn't a headline designed for investors. It was framed as environmental protection, infrastructure control, and regional security. But underneath the language was something far more disruptive. Access restrictions, mining limitations, logistics freeze, shipping delays to key northern routes. When you cut off the Arctic, you don't just block icebreakers. You choke off one of the most strategically important mineral corridors on the planet. And silver sits right in the crosshairs of that decision. Within hours, refiners started paying up. Not a few dollars more, not $10 more, over $100 more for immediate delivery. That is not normal market behavior. That is panic hidden behind professional language. That is the sound of industrial buyers realizing their just-in-time supply chains no longer exist. When manufacturers are willing to pay a $137 premium above spot, they are not speculating. They are desperate to keep production lines running. Meanwhile, the paper market barely reacted. Futures ticked up. Commentators shrugged. Analysts talked about volatility. But the real action wasn't on a screen. It was in warehouses, vaults, and private contracts that never make the evening news. Physical silver started disappearing. Dealers reported delays. Wholesalers went quiet. And suddenly the question wasn't price anymore. It was availability. This is how real market breaks begin. Not with a crash on CNBC. With silence. With premiums exploding in corners most people never look at. With a geographic decision triggering a global ripple effect. Greenland didn't just change access to ice, it changed access to metal. And once that door closed, the silver market realized how thin the margin of safety really was. What we're watching now is not a spike, it's a separation. Paper silver and physical silver are no longer telling the same story. One says everything is fine, the other is screaming that supply is gone, and history tells us which one eventually wins. Because when scarcity becomes real, price doesn't move gradually. It jumps, it gaps, it reprices reality. And this time, the trigger came from the Arctic, not a central bank, not a rate cut, not a crisis headline. Just a quiet lockdown that rewired the silver market from the inside out, starting now. The market is trying to pretend this isn't a big deal. But here's the uncomfortable truth. The silver market has been running on borrowed time for years. The paper market has been inflating a myth that physical supply can always catch up. It can't. Not when you suddenly block access to one of the few remaining regions capable of producing meaningful quantities of silver. When a supply chain is broken, the first thing that vanishes is the illusion of abundance. That's what's happening right now. Let's talk about the $137 premium, because people keep treating it like a headline figure instead of what it actually represents. A premium like that isn't a price move, it's a stress test failure. It means someone, somewhere, urgently needed silver and couldn't get it through normal channels. So they went to the only option left: pay more. And that's not a one-off. This is the kind of premium that spreads like wildfire. Once industrial buyers see it, they don't wait. They buy now, even if it hurts, because the cost of being without silver is far higher. You might be thinking, okay, but how much silver is Greenland really producing? Is this even significant? That's the point. It's not about volume in the grand scheme. It's about the market's fragility. Silver is not a commodity like wheat or oil. It doesn't have a massive diversified production base. It is heavily dependent on a few key mining regions and a handful of refining hubs. When one of those hubs gets shut down or restricted, the impact is amplified. The market doesn't just adjust, it breaks. And the thing most people miss is that this is not a short-term disruption. Arctic lockdowns aren't like a temporary weather event. They are geopolitical, they are strategic, they are designed to last. Greenland is not a place you just reroute around. It's not like switching a factory from one state to another. It's a different world, with different rules, different seasons, different costs, and different access. When the Arctic locks down, the entire logistics chain becomes a nightmare. Ships can't pass, ports can't operate, insurance rates spike. Even if the mines are still producing, the metal may never reach the market. And now, the market is dealing with a second, even more dangerous problem: trust. The paper market survives on confidence. Traders believe that if they own a contract, they can get the metal when needed. But when premiums explode, that confidence evaporates. People start asking, do I even own real silver? Can I take delivery? Will the vaults deliver? Is the supply chain real or just an illusion? These questions don't stay inside trading rooms. They spread to retail buyers, to industrial users, to big institutions. And once trust erodes, the paper market becomes a house of cards. This is why we're seeing a divergence between spot prices and physical premiums. Spot is still controlled by futures trading, and futures are controlled by leverage, sentiment, and liquidity. But physical premiums reflect real-world demand and real-world scarcity. When those two are moving in different directions, it's not a market, it's a disconnect. And disconnects don't last. Eventually, reality catches up. And in the silver market, reality is now screaming. You might also notice something else happening. The silver shortage narrative is suddenly becoming mainstream. Not in the way you'd expect, like analysts warning about supply constraints. No, it's showing up in a more dangerous way, through price behavior. The market is no longer debating whether silver is scarce. It's pricing scarcity. That's a very different conversation. It's not about if silver will go up. It's about how fast it can go up once the market realizes the supply is gone. Now here's the part that will shock most people. This isn't just about investment demand. This is about strategic demand. Governments and large corporations are quietly stockpiling silver because they understand what the rest of the market refuses to admit. Silver is critical infrastructure. It's not just a metal. It's a cornerstone of modern technology. And when a supply chain threat appears, they don't wait for prices to spike. They move first. That's why you're seeing premiums rise so quickly. It's not just retail panic. It's institutional action. So what happens next? The silver market will start to do what all markets do when they run out of room to maneuver. It will break into a new price regime. The old rules will no longer apply. People who were counting on paper positions to represent real supply will discover they are holding promises, not metal. And promises are only valuable if someone can keep them. At the same time, those who own physical silver will suddenly understand the power of being the one with the metal in hand. When delivery becomes the real story, physical ownership becomes the only thing that matters. And that's the moment the market stops being a financial game and starts being a survival story. And that's why you're seeing this moment unfold like a sudden awakening. The silver market has been quietly vulnerable for years, but now the vulnerability is visible. The Arctic lockdown in Greenland didn't just create a temporary shortage. It exposed a fundamental flaw in how the market is structured. It exposed how dependent we are on a handful of supply routes, a few refining hubs, and a fragile paper system that can't withstand real-world disruption. And once that reality hits, the market doesn't just move, it reconfigures. Here's what people need to understand. This isn't just about a premium or a spike. This is about the difference between price and value. The price is what shows up on the screen. The value is what the metal can do in the real world. When industrial demand meets a physical shortage, value goes up, and the market eventually has to catch up. The $137 premium is the first sign that value has already moved. The rest of the market is still catching up. Think about it like this. If you were running a factory that makes solar panels and your supply chain suddenly breaks, what do? You don't wait for a lower price. You pay whatever it takes to keep production going. Because every day you stop, you lose more than the cost of metal. You lose contracts, reputation, and future growth. That's why premiums spike, because the cost of not having silver is higher than the cost of paying for it. And that's why this moment is so important for investors. This is the kind of event that separates the people who understand the market from the people who are just watching it. Because when a market breaks like this, the early movers don't just make money, they avoid losses. They avoid being trapped in a system that can't deliver. And that's the real lesson here. The Arctic lockdown is a warning sign. It's a reminder that the world is changing, and the old assumptions no longer apply. The idea that commodities will always be available if you pay the right price is being challenged. The idea that paper markets can always stand in for physical reality is being challenged. The idea that supply chains are stable is being challenged. And silver is the canary in the coal mine. So what should you do with this information? First, don't ignore it. Second, don't panic. But third, don't pretend it won't matter. Because the market is already responding, the premium is already a message. And messages like this don't go away, they become part of the new normal. The silver market is now in a new era, and the people who recognize that will be the ones who benefit. If you're holding silver, this is the moment to understand why. If you're watching from the sidelines, this is the moment to stop thinking of silver as a simple commodity and start thinking of it as a strategic asset, because when the world's supply routes get locked down, the value of real metal becomes undeniable. In the end, Greenland didn't just crash the silver market, it exposed the truth the market has been hiding. That silver isn't just a metal, it's a lifeline. And when a lifeline gets cut, the market doesn't just react, it changes. So here's the final takeaway. The $137 premium is not a one-time event, it's a wake-up call. And if you want to understand where silver is going next, you need to stop watching the screens and start watching the real world. Because the real world just changed the rules. In conclusion, this is the moment when the silver market stopped being theoretical and became real. Greenland's Arctic lockdown didn't just disrupt supply, it revealed the fragile structure that has been holding the market together for years. The $137 premium is the first visible crack, but it won't be the last. When physical scarcity meets strategic demand, prices don't just rise, they reprice the entire system. The paper market may still look calm, but the physical market is telling the truth. And that truth is this. The silver market is no longer operating under the old assumptions. It's entering a new era of scarcity where delivery matters more than contracts, and real metal matters more than promises. If you want to protect yourself, you need to understand that this isn't a normal market move. It's a structural shift. And the people who recognize it now will be the ones who win when the market finally catches up.